Hello and welcome. I'm Brendan Burnett, NAIFA's Director of Professional Development, and today we're bringing you a webinar in collaboration with our partners at Performex. The discussion this afternoon is about premium financing, a powerful tool when leveraged correctly. Our panel of experts will provide details and insight on how to utilize premium financing for your clients and how to spot good opportunities for it. Before we get into our program today, a few housekeeping items. All attendees are on mute and listen-only mode. If you have a question, please use the Q&A or chat feature at the bottom of your screen. We will address questions as time permits at the end of the session. It is now my pleasure to introduce Mike Pepe. Mike Pepe has 2.5 decades of experience in the life insurance industry, starting with Mass Mutual, later co-founding a full-service financial advisory firm named River Financial Group, and starting the Tolley Group, a life insurance firm designed to fill the gap between insurance consulting and the need for ongoing policy monitoring and management support. Mike is the founder of Performex and currently serves as its president. Performex is an in-force policy management platform helping fiduciaries, financial planners, insurance brokerages, and agents monitor, manage, and govern their life insurance policies. Mike will be leading today's discussion. I'll now turn things over to Mike to introduce our panel. Mike, welcome to the webinar.
Thanks, Brendan, and thanks everyone for attending today's meeting. I'm honored today to introduce today's panel. First off, we have Josh Gopley, Chairman and CEO of the Gopley Organization. Josh has been selling leveraged life insurance for more than 45 years. A second-generation insurance advisor, he has literally spent a lifetime in the insurance industry. His work with high net worth families, closely held businesses, and large public companies has presented the opportunity to use life insurance as an asset class to address a broad array of tax and cash flow needs of his clients. Premium financing strategies have been his core work since the early 1980s. Josh, thanks for being here. Welcome. Keith Gillis. Keith is the past president of NAIFA and the managing principal of Wealth Solutions and the Pension Center, and the co-founder of the United Wealth Advisories Group, where he serves as Chief Executive Officer. He began his career as a financial advisor in 1981 with a commitment to provide advice and strategies to individuals, professionals, and business owners to help them achieve their personal, business, and charitable goals. Again, Keith, welcome to the panel. And finally, we have Roy Levy, president of Roy Levy Financial and Insurance Services. With 19 years of experience, Roy began his career at Tax and Financial Group, where he was introduced to the high net worth markets. 3 years later, he founded Roy Levy Financial in June of 2003 with the intention to design and implement financial strategies specifically for high net worth individuals. He created ARPA, Accounts Receivable Protection and Accumulation, which is a premium financing program that has been approved by many banks and life insurance carriers within the United States. And again, welcome, Roy. So with today's panel, very honored to have everyone on here. Premium financing is a unique animal in the insurance industry. I guess the first thing, that, we'd like to talk about, and I'll send this one to you, Roy. What is the history of premium financing?
Thank you very much, Mike. So when you look at premium financing, and I'll give a little kind of background to both the lending side and the carrier side, it is a strategy for high net worth individuals. It is a strategy for people who understand leverage. And it really started more in the real estate marketplace than anywhere else. So when you think of, typically what a carrier is looking for a premium finance candidate, they always think of someone who is asset rich, cash poor, and is looking to acquire large amounts of life insurance. So how premium finance basically started was for people that were in this area, they needed to find a way to acquire life insurance. And what happened was, and there's different people that have said that they truly started premium finance, the carriers really went out to the banks and started thinking, how can we put together a program that allows people to do this? So it truly is the mindset of someone that says, I need life insurance. I'm looking for a way to acquire it, but it's not the cure-all. It's not for someone that's looking for free insurance. It's not for someone that's not willing to pay for it. It's just an alternative method of funding. So when you think of the true client that is doing this and what the carriers want is someone who has and they talk about all the time, skin in the game. So something that allows people to post collateral, pay interest and or principal for their life insurance contracts, but truly understands that they can keep their money in their real estate, in their business, and make a better return than they're being paid in the interest rate marketplace. So that's truly what premium finance is and why people do it. It's all about the correlations between interest rates, policy return, and what they make on their money. And if you look at the carriers and how they want these things structured out there, they're typically looking for high net worth individuals, high income earners, people in the business owner marketplace that understand leverage. And that is truly the key to this transaction.
Great. Thank you. Josh, this question's for you. Obviously you've been doing this for quite a while. What are some of the myths and truths around premium financing?
Oh, you're saying I'm old.
Oh, look good.
So actually, Roy is right, his description of premium financing. But, premium financing has been around forever. And until in 1986, we were able to do it internally in the policies. But today's premium financing, there's the myths and truths that we've talked about is there's this illusion and people are out saying this is free insurance. There's no risk. Just pledge these other assets, your securities or some other asset, depending what they'll take as collateral, and don't worry about it. And the litigation that we've seen and we're starting to see appear more, and while we've had these extraordinarily low borrowing cost periods, and we've had a pretty good run on some of the index policies, although some of the fixed policies, whole life or traditional universal life, have come down. This is not free insurance. There's risk involved. It's like anything else. I mean, to the extent I'm going to borrow and create leverage, somebody wants to get paid for it. They're not doing it because they're giving me a gift. So the thing about premium finance, in terms of the truths are that if you're going to do this, it's nothing magical about the product as much as it is. It's the correlation between, like anything when you're buying a home, you're not buying a home because it's free. You're buying a home and putting degrees of leverage in there, depending upon what you think you can manage to and what will and what you can support. But one of the things about premium finance, which tends to have short-term interest rates, a year or a few years, is you got to have enough sustainability, you have enough equity, enough excess so that it's sustainable. One of the problems that the carriers have experienced and why they love selling it, but the lapse rate is so much greater than every other line of business they sell, is because people over leverage it. And when the rates turn, when the market goes flat, if you have an indexed or variable, when you have those kinds of products, suddenly the economics change and you don't have control to do it. So having a pool of equity or either that's pledged, or if you're putting money in that has enough that you have room for bounce, the sustainability, if you're really truly doing this for the duration, then you need to make sure there's enough value there that you can sustain low interest rates, low returns, or high interest rates, or you're going to find yourself upside down in a hurry.
Yep, for sure. Thank you. Keith, this question's for you. Obviously, you work with a lot of advisors who have clients and prospects, but who typically qualifies for premium financing?
Well, first, I want to agree 100% with my colleagues Roy and Josh just said, and they gave some really good points about doing this. So now let's talk about a typical prospect, and Roy can add some color to this because he's doing things a little differently. But what we're seeing is premium finance used a lot, particularly in the estate planning area. And what we're looking for there is high net worth people who understand leverage, they understand arbitrage, and they understand the risk of doing this, but they need to fund large life insurance policies for potential estate taxes or to fund trust. So that's generally what we're looking at. High net worth people, generally, we start looking at about $5 million of net worth to get into the game here with what we're talking about from an estate planning standpoint. but there are some other opportunities. And this is, the estate planning is to allow someone to fund a large life insurance policy with some limited cash flow because they're using leverage and arbitrage. And as long as we understand the risk on that, we're fine. Then Roy also has some ideas, which I'd like to hear him talk about, where he's using it for high income people who are trying to create cash flows future in their future lives. So Mike, that's kind of where we're seeing it, where our focus has been. But every time I'm on something like this, I learn something differently and something new that we can use. So that's how we're using it. Thank you.
Thanks, Keith. And Roy, can you step in and share with everyone how you're utilizing it as well?
Yeah, one thing that we've seen from a lot of carriers, and I think it really plays into both, the past tax code and where it potentially is going, is looking at life insurance as an asset class. So if you were to talk to many banks and kind of their book of business 5 years ago, you would find an average age at around 62. Well, that has been coming down over the years. And really what it attributes to is people are starting to do these plans for supplemental income. And some of the benefits that we see in doing this is really extending the runway for a client. A lot of people set up executive bonus plans, whether you're using it for variable life, index life, whole life. And one of the big flaws of those things is they can't put in more money. There's not a whole lot of flexibility. What premium finance does, it allows for a lot of flexibility. So kind of like Josh was saying that, you don't want to over leverage these plans. These are just plans where you're trying to give a client, especially the young, let's say the 40-year-old doctor, 45-year-old doctor, business entrepreneur that's in generation 2, 3, et cetera, the ability to put away more money. And you're not over leveraging it, but you're giving them flexibility to really ride out some good times and also the bad times to help with their supplemental income. And I think the tax code is really going to dictate a lot of these sales in the next couple of years.
Mike, if I can add into that. So, I mean, we certainly use it in the estate planning and wealth retention mode. We use it we also, I spent much of my career in almost 50 years doing non-qualified plans for closely held businesses, for large public companies, Fortune 50 companies. And where this, the today's era of premium finance comes into play. I mean, if you think about, most people understand a real estate transaction, okay? People have made enormous wealth in real estate. And it's not because they bought a piece of property and the value increased by 12% every year. It's because they put 20% down and earned 6% on the growth and the income of the property. And maybe they borrowed 80%. And on that 80%, they had a cost of 4 on the borrowing, and they made a 2% spread on essentially 4 units relative to the one of pure equity. So they made 6% on the equity portion and 2% spread on 4 times that. So they might make a 14% return. And it's not because the property grew by that. And with life insurance, similarly, today especially, and you look at this, I mean, if you buy just life insurance and use it as an accumulation vehicle, which we've all shown, levered or unlevered, it's kind of an unlimited Roth IRA. I'm using after-tax dollars to grow my assets, income tax-free, and I have a death benefit, which obviously is needed as well. But if I live, and most people want to think about what happens when they live, not when they die, I can accumulate money on a tax-free basis or a tax-deferred basis and access it, if we're running it right, if they're operating it right, tax-free. So in a corporate world, whether I'm doing it individually through deferral plans, whatever, it gives, as Roy said, it gives the owner, whether it's a deal by whether we're using it, for example, for companies to accumulate money in a non-correlated asset, and they get a higher return than just buying the life insurance, because if we can run this to the spread. And the game in premium finance is not about it's not about do I get the lowest rate or do I have the best return. It's about managing this thing post sale to the spread, the crediting rate on the policy relative to the cost of borrowing. And if we can manage to a positive spread, depending on the policy, above X or Y, a 1% or 2% spread, I'm going to build up excess assets and I'll pay for the insurance. If I'm just going to lever it to the hilt and I don't and the rate of crediting is going to be less or not enough to support the borrowing costs, it's going to go upside down. And when rates go up, and suddenly I have to come up with more money, or the collateral, because I've just pledged collateral, it falls because the market falls, I'm going to be upside down. There's going to be a huge cash call, and then you're going to start seeing the litigation. So, managing this stuff, part of what's the plug for Mike said, part of the Performex system that we're integrating into our technology is having data that I can access and make sure that we're running and managing these policies and these plans on a long-term basis. Because if I don't do that, they're going to blow up. This is not something that you put on a shelf and watch paint dry. But what we get to do with premium finance is we get to help our clients get the amount of insurance they want or they should have, rather than what they're willing to pay for.
Yep, for sure.
If I just might add to it, Josh, Josh just nailed it. This is not a sell it and forget it. It has to be managed, and if not, then you're opening yourself up to some trouble. And my thought is that if you have just like one case on this, is to team up with someone else who really knows what they're doing, so that number one, you keep your client out of trouble, and number two, you keep yourself out of trouble. So just wanted to add that. That was a great explanation.
Yeah, and that brings up the next question, Keith. We'll start with you, but then we'll ask it to the group. The value of joint work. Obviously, we hear it in the industry, but with premium finance, and it is complex. It's not set it and forget it. So, can you talk about joint work for you guys, and why it's so valuable to the advisors and their clients?
Yeah, with every case, there's probably, Mike, not a case that I do that's 100% for me, even if it's my client. And it's, we have different splits because different people have different expertise that they can bring to the table. And what we sell is a team concept anyway, that, hey, look, I'm putting together a team of experts to help a client. And whoever it is we need to bring into that is what we need to do. So sometimes one of my partners, colleagues, or fellow advisors within our organization will bring me in, and I get a smaller piece of that case, but I'm brought in to do something specifically for that case. And it's the same thing with premium finance. It's very complex. You really have to know what you're doing. And if you don't, please bring on someone who does know how to do that with you. And it's an old saying that probably Josh and I have used for 40 years. 100% of nothing is still 100% of nothing. And 50% of something is better than 100% of nothing.
Yep, for sure. Roy, how about you when it comes to joint work?
So we work with advisors around the country, and really our value proposition is about the maintenance of these plans. So when you look at it, we talk about the 4 prongs of what we do is we're going to help design the case, help sell the case as needed. And that's really on a technical analysis more than anything. Find the correct funder and then administrate. And that is really the biggest piece is the administration. When you look at a lot of advisors that are out there, they are almost, and in a doctor's sense, they're a general practitioner. They're trying to acquire the client. They're trying to do many things for them. We are there for a specific task. Our job is on the premium finance. And the big thing is, and that's why we do team up with Performex and with others on administration. It's really looking at it, and it's also looking at the carriers. So people always ask us, why do you use certain carriers? It's looking at their admin side, looking at their technology. Those are things that we value heavily to see that how are these plans going to succeed down the road? Because if you're not getting the data that you want, whether it be from a bank or from a carrier, these things don't work. You have to have these types of technology platforms to really service your clients. And that is very valuable.
Yep.
Hey,
Josh, how about you?
Mike, I got a couple of questions that have come across my screen on else's that I thought we should answer. People have asked.
Okay.
The first one of the, by the way, one of the questions, this the webinar is being recorded, and you can get that on the NAFA website. I think they have all of these things that they record, and they can talk about that later. The other question was, is it appropriate to use premium financing for tax-free retirement income? And my answer is, generally, I would say yes, and we do that a lot, whether it's for an individual or whether it's for a and the corporate setting. Most people love, our clients, we tend to do larger, have wealthier clients than some of the levels have, but most clients don't buy the amount of insurance that they should have because they love their family, they love their kids, but they don't want to focus on the fact that I'm buying life insurance, I'm dying. They'll do enough so that people leave them alone. We've found that when, as Roy said, we use this, and for over 40 years, it's been an asset class that we use, and we sell it as that and run it as that. If I can create, it's a great way to build money on a tax deferred basis. Run it right, I can pull it out tax deferred. If I'm in a corporate setting, I then could, if I had a 7% return on the levered portion only, I could gross that up and pay my employee a 10% return that they'll have taxable. But if I have this thing, I can create this extraordinary tax-free retirement income. Again, it's something you can't just put on a shelf, you got to work it. But, and there's the design. And I would tell you that if you've not done this or you're thinking about it, think about your wealthiest clients. Think about your clients that you haven't been able to get them to buy insurance or enough and much insurance. And I would encourage you to find somebody that has done this before and partner with people on it, until whenever you can do it yourself. Don't go and do this alone. It'll screw up and then you'll have a bad experience. I would say find somebody that knows what they're doing. The other question was, there was a question about, do I think AG 49 is going to create difficulties to justify the sale going forward? And the simple answer is yes. I think it creates difficulties. Doesn't mean it's bad, but because the AG 49 is going to limit some of these things. It's going to limit what I can illustrate. But I'm old, so as Mike's established early on, I'm old. So, but there was a time in the 80s, 90s when we were seeing long-term rates illustrated at 12%, 10% compounded. People say, "Oh, rates will never go down to 8%." Well, 8% would look pretty good today. So people buy illustrations, and the question is, so you're going to have a different degree of leverage that's going to make it work when you have lower rates when you're illustrating it. But right now, when you look at what the limits are that the carriers today allow us to illustrate, we're earning 25, 30% higher than that, but we can't show that. It's a crazy environment. So it makes it more difficult, but it still is, look, it's a strategy. And I would tell you, saying I don't put any money in this deal and I'm just going to pledge assets, my personal observation, that's a recipe for disaster. You've got two asset classes, then you've got leaning on each other, and you have contagion when there's a problem with one. So if somebody's going to do premium finance, decide what their budget is, build to their budget, and build it with enough bounce so that you have sustainability as opposed to just shooting for the best rates of return.
Yep, that's for sure. So Keith, I guess for you, playing off of these advisors have never done it before. What is the best way to get started? What opportunities should they look for? Can you share some?
1-800 call Roy. No.
Well, that would be a good start. 1-800 call Roy. So find someone who can really help you with this. And to Josh's point that he made earlier about the questions, on the first, can you use this really if you're looking for someone, the young executive who has a substantial income, the young physician, maybe the young professional. And if you think about this, and Josh said it just right, this is not a 1 year, one-time deal where you're selling the illustration. You have to advantage of the time and leveraging the arbitrage in order to make this work for a distribution, a cash flow later on. That means you need to be on top of this every year. Regarding AG 49A, if you really want to be conservative, you can take what the companies allow you to illustrate and then just take a point off of that, or take a point and a quarter off of that, build you up some room in that illustration in case you have a bad year or two, so that you protect yourself. And then again, if you come across someone who you think has a substantial estate, who may need a very large life insurance policy, 1-800-ROY, or call someone else who can help you design that contract and help you maintain that over a period of time. Please don't try to do a one-off on your own.
Yeah, for sure.
One of the things going back to this, a couple things. If you're going to do this, and you want to build retirement income, do not, I tell people, if you're going to do this for less than 10 years, don't. It's a bad deal. If you're trying to get income out of it, because this, at the end of the day, what happens is you're going to have, you got the credit side is the earnings on the cash value, whether it's variable, fixed, indexed, it's the crediting. And then on the other side, you have two pools of expense. You have the cost of the borrowing, whatever the debt is, plus the cost, the monthly or the quarterly annual cost of insurance. And the goal is get enough cash value in there so that the returns on the cash value gains can outperform the drag on the costs. And if you can't get there, it's still a better deal if you're looking at cash conservation. But if you're trying to build something, that's the issue. And it takes, I tell people, don't think we're going to get any returns that you're going to be able to pull out and live off of in the first 10 years. If you don't think you're going to make a positive spread of 2% or more, either put more money in or don't do it, because it'll blow up. It's not free insurance.
Yep.
And I think Roy would say that on these cases that he's developing for cash flows later on, it's well beyond 10 years.
Yeah,
I would agree. You're really looking at 15 plus. And one of the other things I would say, and you guys are both hitting it on the head, is you got to stress test these things. So you have to look at different scenarios when you're modeling these things out. You can use AG 49 as a baseline, but the client has to understand the banks are going to look at this from a zero return. They have to understand you're going to get different areas of return all along the lines. And that, I think, is more the challenge of AG 49. You really can't scatter plot things, but you have to be able to manage the expectations of the client and do so in a manner that you're trying to overperform. Right. So you want to look at it from a scenario that you're looking at, and that comes back to what Josh started with, of saying they have to have enough collateral, they have to be liquid enough to do these transactions. That is a huge part of it. If they're not, they shouldn't be doing this. This is something that it definitely does have financial requirements, and it also has requirements that people need to monitor. And that's where this is truly a financial planning tool, and people have to monitor it. And I would always suggest teaming up with someone that knows how to administrate these things, because this is not the job of a lot of people, and that is key.
Right.
Yep.
I mean, on that side of it, right? I mean, like we've built, because my background in qualified plan administration, the work in non-qualified plans, when I was younger and had more hair. There was a time I was younger, Michael. I used to get beat up a lot at these large public companies by the financial people because they want to know everything and to the last detail. And as a result, over the last 40, 50 years, we built a technology we called our MAID financial technology, managing assets, insurance, and debt, part of what we're integrating with Michael's system. And every month we look at it. We have a detailed, we call it the Falloff Chart, and we run a line that says, here's how the bank looks at it with zero crediting. So those expenses of interest and the insurance expense, those are important to know, because we want to see it and be able to talk with the clients exactly how the bank sees it, so we know what they need on a guaranteed basis. Because the bank says, look, I'll give you all this collateral weighting, but the thing is, I want to know that on a guaranteed basis, I'll take the carrier risk, but I want to know on a guaranteed basis, I don't have to talk to you again for a year. You have enough there that if you earn nothing, I don't have to come back and worry about this. And so what happens is, and then we have another line where we're looking at what the projected crediting. So, we're marrying that and balancing that, and we're looking at that all the time. And people that have been doing it, Roy has been doing this a long time too. When people have been doing this, the importance of watching this is no different than like you would watch your statements. If you've got, your equity investments, most people that have accumulated wealth have, they understand levered real estate because they do it with their home, and they do it with, maybe they're invested in some other partnerships. They understand equities because they've got a portfolio. And all you're doing is adding this instrument called life insurance to it, which if you've dealt with them, they have some element. But when you pull those together, I found that that's an easy way to explain what's going on. Or if you have a fixed product where you're looking at, you own a piece of real estate and you have a certain return, it's the same thing. But breaking it down into pieces, I think, is important for clients to understand, because when they hear life insurance, people tend to roll their eyes backward, and when you start talking, what goes on in their head is blah, 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 blah. So I've found that in my many years, that it's important to get that, to try and take this into a language that they can relate to.
Yep, for sure. Going back to where advisors start, look at your book of business, look for large policies and large premiums. There may be a better alternative to get more insurance, and instead of paying premiums, you're paying interest. But a question came in here, and Roy, I'll address it to you. Can you premium finance current in-force policies that they're paying premiums on?
Absolutely. So we look at, and the one thing that you have to consider always when you're looking at an in-force policy is how is it structured? Because typically when you're doing a premium finance policy, you look for something that the death benefit is going to increase. What in-force policies do, especially that we're seeing right now, is it gives you a great baseline. So we're doing a lot of cases where we're looking at someone's in-force book of business and in-force policies and saying, let's add on to it. So you've done a great job. You already have something that is growing. Let's say it is like a whole life, IUL, et cetera, that is growing. Well, why don't you put another piece onto it? Build in some flexibility. We're seeing a lot of those cases right now. And really what I always think of premium finance is flexibility. It's flexibility in payments for the client, and it's managing risk. If you look at a typical business owner and their taxes, it's never a straight line. They pay things differently every year. Some years you're going to pay more, some years you're going to pay less. It just happens that way, depending on profitability, depending on how your business is going. Premium finance allows for that flexibility, and that's where the monitoring process comes in, and that's truly one of the huge benefits that we see.
That's great. Another question came in, Josh. I'll direct it to you. Can you do premium financing over multiple policies, like a portfolio of policies?
Yeah. In terms of currently, we've done pools of 100 lives where we'll marry them, and it depends. So in some of the corporate settings where we might insure, with some of we have a proprietary an ESOP strategy, for example. We have a patent pending on that, where an ESOP is a new ESOP, which is where a company owner sells the company to their employees, and it's a qualified plan. It's a tax-free environment, but we're using this as an alternative asset class. The liabilities tend to be nominal till you get out to year 10 or 15. So it pairs perfectly with the maturity that happens in these premium finance programs. And so, we may be insuring 100 or 200 of the employees who are now also business owners, but it might be funding liabilities for 300, 400, 500, 1,000 employees, and using that in the out years for not just at death, but during lifetime. And if they have an early death, typically we'll use that money to delever and make the program more sustainable. In an individual setting, we oftentimes are using multiple policies. Part of that is diversification for with different carriers, sometimes with different kinds of strategies of insurance, and using what Roy was just talking about, where somebody's got an old Northwestern Mutual, an old Mass Mutual policy. It's a whole life policy. New York Life, it's got a lot of cash value. Well, you can use that cash value. Typically, lenders today will give a 90 to 100% collateral weighting on the cash value of a high quality life insurance company. So if you're using that, maybe the new premium is $500,000 a year or $100,000 a year, maybe you only need to pay another 25,000 a year because you can lean on that cash value, as Roy indicated, to that. So there's a lot of cool ways to do the structuring. And again, you know, trying to sit home and figure it out yourself is a bad idea. Working with somebody that has done this and kicking around ideas is something you'll see things you don't see before. And in my experience, there was a time when I was younger and I did a lot of joint work with people over the last 40 years. And that was the way that I learned a lot of cool things.
Yep. No, that's great. Keith, I got one more question here. We'll start with you, then we'll open it up to the group. Obviously, you know, the advisors and the agents know what it takes to place a policy in force, but what is the life cycle to get a premium financing case done? And, you know, what are some of the roadblocks and what are things that can be done to speed up the process?
Oh, well, this is not a 1 week process. It takes weeks to bring one of these home, and it's just the nature of the big cases anyway. Even before premium financing, if you weren't using premium financing, if you're talking to someone about a 25 or $50 million second to die or first to die or single life insurance need, those take time anyway. When we add premium financing on top of that, now we're talking about the process of having not only the client understand it, but often they're bringing in their other advisors, their CPAs, their attorneys. It takes time to go through all of that. It's an education. I even made some extra notes today from what Josh and Roy said about explaining this and how it works and understanding leverage. So my experience is that these take not weeks, but often months to get over the finish line. And then you have to get to, once everybody agrees to all of that, now we need to talk about underwriting of 25 or $50 million or more of insurance. So then there's a trial app period or a pre-application, pre-underwriting period where you're trying to get an idea of what kind of rating you're going to get for the client. So Mike, these are not quick things.
Yep.
If you're going to hunt in this market, well, you better have some other cash flow coming in.
Yep. That even brings up the more importance to doing it jointly with specialists.
Well,
Josh or Roy, anything else on the cycle?
Roy, you want to go first?
Yeah, one thing that I'll add in is always, and this is something that, you know, a lot of people think of, again, in the free insurance model, et cetera, collateral is key. You have to know the client's liquidity. And the sooner you start the process, whether you're going to be using a brokerage account, cash accounts, where they're held, that can slow the process up more than anything. And if you're having to swap out collateral or search for collateral from different institutions, documentation can take a while, especially during the COVID times. We've seen this where that can really drag the process out. So one piece of advice always is, I mean, you guys are great at selling this. You sell the life insurance first, but when you start getting to the technical side of the loan, is really work that collateral side and know that up front.
Well, the biggest mistake I think that I see in people that are doing premium finance that extends the time, because as brokers, we want to sell the deal, they buy into it. Once the client says, yes, we think we should be paid then, but we forget sometimes we have to get the medical underwriting and so forth. I think the biggest mistake I've seen is people go and underwrite an insurance policy and then start the premium finance underwriting. They go find a Keith, a Roy, or somebody that is doing this, and they start to then bring it to them to go do that. And they're doubling the time or adding a lot to the time. We tend to run it jointly. Many of the carriers today want you to tell them up front if you're going to be looking to premium finance it. They want you to disclose that up front because they may underwrite it differently. And so, you know, if you're going to do premium financing, start that process at the same time. It's a whole different underwriting. It's getting all the data. It's know your client. It's knowing their cash flows and making sure that you're, you know, that it's matched right and the level of debt. Because typically in our world, depending, and there's a couple of main lenders we use, but typically we'll have anywhere, we've done a deal, we've funded a deal from start to finish, applying to getting it in 5 days. And that's because the nature of the relationship and what we do with, you know, our team has done an extraordinary job of building great relationships. But and we've underwritten the policy in 5 days. That's not normal. But typically the loan underwriting, we can get that done quicker than the life underwriting is going to get done. And part of that is just it's organizing, it's knowing exactly what you need. You know, the mistake that many of us as brokers do is we think we want to get it started, so we start sending piecemeals to the carrier or the lender, and it's just annoying to them. I want us to be brought to the top of the pile. We're going to collect everything we need. We know what we need. We're going to do our own internal underwriting. We know the package is clean. We're going to send it to them, look it over, tell them it's coming in advance. We have it scheduled. We go through it and then we're just documenting. And listen, there's always things that come up. You know, what I know is expect the unexpected. You know, hope for the best, but expect the worst. That's what all of us that have been doing this know. But so it never works out perfectly. But you know, you should be able to get the premium finance should be able to be underwritten and you should be able to close it at the same time you're closing your life policy if you've started concurrently and you're dealing with somebody who knows what they're doing. It shouldn't take any more time, my view.
No, that's great. You know, one other question I just came to mind here. It's really not a question. It's probably, you know, I'll ask the group. You know, these are complex. You're working with multiple advisors for the insured and the policyholder. I gotta believe that leads into additional opportunities and relationships. So even though it's more complex, takes more time. I mean, I'd like to hear from you guys. I'm sure there's stories where it led into more cases for that advisor that you did joint work throughout their centers of influences. Because it just makes sense. They see you guys as a specialist, and that advisor now has access to that CPA, that attorney, and I got to believe it leads into more opportunities.
Yeah, I'll just say, Mike, that we're working on a couple of cases now, and when we had that meeting with the other advisors, it was amazing that both of them reached out to us afterwards and said, "Hey, listen, I've got some clients who really could use something like this. Can we set up a meeting?"
Yep.
And you can take advantage of those things.
Yeah, for sure. For sure. Well, guys, this has been great. You know, Josh, Keith, Roy, thank you very much. I do not see any additional messages in the chat. I don't know if you guys have any additional in your chat boxes, but I don't have anything in mine.
Well, I want to thank you, Mike, for inviting us, for getting me to put a tie on for the first time in many months.
Yeah.
You know,
Yeah. Well, you look good. You look really young, Josh.
I know it's that thing you spray. No,
Mike, I got the same memo as you, so we're good.
Yeah, exactly. All right. Well, again, thanks everyone. With this, we'll turn it back over to Nafa and Brendan to round this out. But thank you very much.
Yeah, thanks.
Thanks, everyone.
Well, thank you, Mike, for leading this informative discussion. And thanks to everyone for joining us today. We were discussing this earlier, but I want to reiterate that the session will be available on demand on NAFA's website, and you'll also be receiving a follow-up, all of you attendees who joined us today, regarding accessing that recording. This concludes our webinar. Enjoy the rest of your day.